Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, joined by Amy Zhang, Executive Vice President and Portfolio Manager at Fred Alger. We have David McNatt, Executive Vice President of Investment Solutions at AssetMark, and Markus Hansen, Portfolio Manager with Vontobel. They join me to discuss portfolio diversification and positioning and how advisors are thinking about allocations for 2024. It is great to have all of you with us. Amy, I want to kick it off with you. Your small caps are finally starting to participate here.
Yes, finally. You know, small cap has been a bear market for almost 3 years, and largely due to the fastest and most furious rate hikes, right? And now, finally, I think, you know, no matter what, the big picture is we're at the end of the rate hiking cycle. So the headwinds are turning into a tailwind.
Yeah, and David, of course, when we think about the macro environment, inflation is still a concern, regardless if we get rate hike cuts or even an inkling that they might be thinking about dialing back a bit. Inflation still feels very sticky here. What are your thoughts?
Yeah, inflation does feel a little bit sticky, but we are seeing, I think, positive movement, and I do think we are on sort of a journey towards the Fed's target PCE core rate around 2.5%. We think that's probably happening around 2025. I think the market's maybe a little ahead of itself in terms of how it's thinking about rates, but we do think that we're on the right path.
Yeah, and Markus, when you think about your macroeconomic outlook into 2024, we still have not had this recession. It's failed to materialize. What do you think some of the factors were in 2023 that lended to the lack of materialization?
It's a great question because it's the forecast everyone's looking for. We've been waiting for it. I think net, we're still normalizing after we've come out of this particular weird cycle of the COVID shutdowns, the reopenings. It's where the Fed models got caught off as well. I do agree with both the panelists that we are going to see probably an easing of the rate scenario, but not maybe immediately. They got caught off guard when it took off. They're going to be more cautious when it comes down. So the impact, I think, of rates we haven't seen fully yet on the consumer. We are seeing incremental evidence from different companies, what's happening particularly at the lower end, but even at the middle end. But on the inflation side, some interesting comments as well. I think the CEO of Walmart was out today commenting about particularly one sticky part, labor service costs are starting to come down. And then on top of that, the other big piece in the CPI, the rent side, is starting to turn down as well. So trend is their friend, but I think caution is probably what they'll have going forward. And that may still keep a cap on where the economy goes for the near term.
Yeah, and that was probably one of the mistakes with messaging when they were talking about inflation, you know, over the past couple of years, that it's transitory. I mean, labor and wages, you're not going to pay someone $15 an hour and then dial it back to $12 an hour. It's just not going to happen. But I think another key theme is you can't bet against the consumer. They just keep firing away with spending power.
The American consumer in particular has always been very good at getting out there, and look at what happened during COVID, complete opposite of what everyone thought. You weren't saving, you were buying pools, cars, and so forth. I think that the big chunk of large consumer spending discretionary items is behind. We've seen a move to more experience and services, the recovery of tourism. I mean, just walk outside in Times Square, you see tourists are back, people have been flying to Europe. I was there recently. That's the last bit of the leg, but realistically now we are starting to see the impact of rates in terms of mortgage costs. That has impacted obviously housing, we've seen that. We're also starting to see some pushback on the labor side. You know, job hires are starting to ease. You've seen comments about how wage pressure is less there as well. So we will see a natural slowing. Whether that tips into recession or just a soft landing, maybe the Fed actually pulls it off. And so far what they've said is data dependent because the models were wrong. So let's go by the data and we'll get there. And I've got to give, you know, Fed Powell, he's actually been consistent in his message.
He has been consistent in his message, and that's why it's so interesting to see how people are looking at 2024. I don't feel, I mean, we have the meeting next week, right? We're going to get the decision on Wednesday, December 13th. I think it's going to be one of the most key decisions that they've made all year. I mean, people are going to pick apart every single word to see if there's clues in terms of when rate cuts are going to happen. Yeah.
And I think the Fed, you know, likely is going to continue to its tough talk. I think the Fed has been pretty consistent on this. There is a longer, you know, a higher for longer. Yes, I do think you are starting to see data soften on the labor side. I think unemployment's moved up to about 3.9%. We had that JOLTS report earlier in the week. Again, these are promising data points. But certainly there's nothing to indicate that the economy is collapsing or that economic activity is collapsing. So I think we'll hear more of the same from the Fed next week, which is there are some improvements. We're watching the trend. At this point, we think the rates are appropriate for the environment, the current environment that we're operating in, and again, will be data dependent going into 2024.
Well, of course, you don't want to make that extreme pivot like we saw in the late 70s, 80s. I mean, that would be the worst case scenario, and I think they're using history as a guide there, wouldn't they, Amy?
Yes. I think it's a little different now. Like today, this morning, right? The job markets are definitely cooling. I mean, you saw the job creation, especially leisure and hospitality has been, the spike, right? Like the high labor costs really came from there, and then had a most significant decline. Now based on the ADP data this morning. So I think labor market is definitely loosening, job market is cooling, inflation is cooling. So I think, to that extent, we are, of course, the Fed is data dependent, but I think we're really very much close to the end.
Yeah, and if they do bring rates back in, I mean, that's going to be, good for the stocks that you cover in the small cap space.
Oh yeah, definitely, because it's very, highly correlated, like long duration assets, right? But actually the kind of companies we invest in, as you know, Jill, we really focus on secular growth companies. At Alger, we're stock pickers. So I'm just happy that we're back to the normalization, like, Markus said earlier, that we can back to, really focus on fundamental bottom-up, use our fundamental bottom-up stock selection approach, that we really invest in companies that can control their own destiny, capital light, structurally strong balance sheet, structurally high gross margin that can do really well in a slowdown and recession.
When you think about the macroeconomic outlook for Europe relative to the domestic outlook in the U.S., and anyone feel free to answer here, is there a theme that we might not be seeing in the U.S. that Europe may be seeing? I mean, there are nuances in the differences with the markets there.
Yeah, so Europe has never really gotten into that velocity escape in terms of economic growth that we saw the US coming out of the great financial crisis. And there's a number of reasons why, in particular, just reform of the banking environment, which happened faster here, allowed credit to come back and economic growth to come through. And in the backdrop, you're going to remember, if you're in Europe, and I was just there a couple of weeks ago, you have a major war going on nearby, you have a regional conflict as well, there's a confidence factor impacting. And then politically, there's always back and forth. So, I know we talk about US politics being somewhat dysfunctional. Go to Europe and it's kind of all thrown an extra salad of dysfunction there as well. So I think there are elements that cap the growth there. What we do as fundamental investors, and again, similar to Amy, we're bottom-up stock pickers. We're looking for companies that have durable franchises, that have pricing power, can grow through pretty much every type of cycle. And Europe actually is home to a lot of very strong global franchises. Think of the luxury goods companies, high-end sports cars, some of the leading consumer products companies, and even in IT and tech, things that you maybe haven't thought about, like SAP, a leading CRM company, ASML, the leading manufacturer of chip equipment, but the Hermes, Ferrari, Vinci, L'Oreal's of the world. And where they've derived their growth is they've got a core European base, but really they've been very successful in the US and in particularly in emerging markets, which are growing middle-class spenders. And that's the kind of thing we look to invest in. So geographically wise, Europe is so-so, but it's the benefit of the companies you can buy there on valuations, which can be much more appealing than some of the US listed peers as well.
Well, let's talk about positioning here for a moment. And I'm going to kick this off with you, David. What are you hearing from advisors? What are some of their top concerns? How are they thinking about allocations for 2024?
Yeah, it's a great question. I would say that most of the year in 2023, again, most of the advisors that we work with, they're focused on building durable, long-term position portfolios for clients relative to their goals. But for a lot of 2022 and 2023, there has been some taking risk off the table, taking duration off the table, really moving up on the quality spectrum. Over the past couple of months, we have seen advisors start to sort of increase allocations back to more of a baseline allocation, I'd call it. So what we are seeing is people stepping in. We started to see, the 10-year peak about 8 weeks ago, and a lot of advisors started leaning into that and taking advantage and starting to extend out duration. So we've started to see an extension in duration on the fixed income side. People still very much focused on high quality fixed income. You can still get 6% plus yield on investment grade, on NBS, so a lot of attractive opportunities in the fixed income side. On the equity side, I'd say I'd call this sentiment more of a cautious optimism. People tend to still be leaning a bit more quality focused, a little bit more defensive. I think there's still recession risk on the horizon, and until that clears, I think people are just taking a little bit more of a cautious stance on the equity side.
And of course, we have the variable of the national election coming up this year as well. I mean, if we thought there were fireworks in 2020. I'm sure we're going to see it certainly for 2024 as well. Amy, let's talk about small caps for a moment again. Are there specific sectors within the small cap space, any names that stand out in particular?
Well, I think, healthcare has really been very, depressed, right? Like for not justifiably so. And we think it should be a comeback year, especially in small cap, growth space, right? Because healthcare is both defensive in the short term, right? No matter where we say we invest in companies that save lives and improve quality of lives, and meet an unmet medical needs, especially, both, tools and diagnostics sector particularly has, they kind of did too well during COVID. I call it a COVID hangover, but now the tough comps are becoming easy comps. So they are really stabilizing, and they should be able to well positioned to reaccelerate growth, in 24. And the medtech company, a lot of them, of course, it's not Pacific. Some of them are just really unfairly hurt by the GLP-1, right? So I think valuation has become very cheap, but of course it's going to be Stop Pacific. And then on biotech, right? Biotech is very attractive, I think, small caps, but especially because they've been a 3-year bear market, mainly because of rates. And they are very, usually, biopharma companies are outperform like in the last 4 recessions. So if we worry about slowdown, they're very untied to economy because they really save lives. So of course we focus on companies with very strong clinical outcome, efficacy, safety, and M&A potential and so forth. So I think healthcare as a sector is very attractive. And then there's also AI theme, as we discussed before. So to that extent, a lot of companies, and as you know, like whether we focus a lot on AI users and enablers, for example, a company like Schillinger, right? They are like, a physics-based software company that really using AI to accelerate drug discovery, right? Like some billions of compounds, you can do it in a much shorter time and which much better probability, outcome. And also like Pros Holdings, which they've been using AI, both predictive and generative AI for a very long time, and to really turn data into actionable insights for sellers.
Yeah, I also think it's important to note too, in the biotech space, of course, you have the key healthcare conference coming up
right
in January, so that's one of the catalysts that you're going to be looking towards. Back to you for a moment here. You clearly fundamental, bottoms-up approach. Any specific sectors, profiles of companies, any investment styles that you're looking at when you go into 2024? How are you positioning?
Yeah, we really stick to the same long-term story, which is good quality companies which run their business well, that have strong franchises, strong pricing power, which the good news, we got to prove that during the recent inflation, because you can talk about it, but unless you go through a cycle and see it, the evidence is there. Can drive earnings, free cash flow, reinvest. And we like a good balance of not just sustainable growth, visible growth, predictable growth, but also nice returns to shareholders in terms of growing dividends, which are even better than bonds. I mean, one of the arguments here is, okay, if the bond market's peaked and turned down, you can buy a number of companies, whether it's a Coca-Cola or a Pepsi, who've grown their dividends sustainably for the last 50 plus years, dividend aristocrats. Those are great long-term investments, and they've shown the proof in the pudding, as my mother used to say, in terms of their pricing power and their ability to drive volume and mix. So no particular secular story. I think you mentioned AI, which is interesting because whenever there is a new disruptive technology, who can adapt to that as well? And where are the early real uses of AI? And I'd come back to, for instance, Walmart, which we're invested in as well. They talked today actually about how they're using AI in terms of their automation management. So if you go to their latest warehouses, and I know Amazon uses this as well, the AI allows them to predict warehouse management in terms of where inventory is. Every bit of dollar you save on inventory management comes back into your cash flow. So again, there's a lot more to come from AI. I know there's the big hype, but there are real uses which we're seeing being implemented today. Also remember, the more automation, the more you can cap your wage issues, because you allow staff who are maybe being higher paid to be used in more dynamic, productive areas rather than just doing menial jobs. So that also solves a lot of solutions for companies. And remember, Walmart and Amazon are the 2 largest private employers in the United States. If they're doing it, everyone else will follow suit.
And which is so interesting too, because I felt like 2023 in terms of the financial media news cycle, let's try to identify what stocks, what companies are leveraging AI. I'm wondering if 2024 it's going to become, okay, let's quantify it now. Is there a proven revenue stream? Are these products available for consumption? Almost, we were talking about this off camera, almost like with ESG metrics. How do you quantify what you're saying in terms of how you're leveraging AI? So I'll be curious to see if the analysis of companies relating to AI is okay.
Yeah.
You had your year of let's talk about it, now you have to show me.
Absolutely, and how do you show it? You show it in margin numbers, you show it in cash flow, you're showing your ability also, coming back to the ESG part as well, which is integral, managing waste. If you can manage your working capital better, you reduce waste, generally that's better. And also in terms of, I think Coca-Cola used AI to develop new designs of bottles and also how they structure the drinks. So there's a lot there. The question is, to your point, what's real, what isn't, where can you see it in the numbers? And then the onset side is, as people invest on this, they're spending on the technology or the data software, SAP for instance, or some of the other larger US names. So come to the Magnificent Seven, which are driving things, there's elements of AI in there. But there's real applications, and there's also stuff which is maybe longer duration. Where ahead, to your point, I think some parts of the market have gotten ahead of themselves.
Yes.
Not just on the macro, but also on maybe the micro, what the numbers and forecasts could be. But generally, big disruptions create opportunities. The best companies that can adapt can become winners on that. And that's the new phase of investment. And so, there's always a bull market somewhere in certain stocks, we think stock-wise. What the market does, we care less about specifically, but fundamentally there's always bull markets in certain companies and names, and disruptions tend to lead to opportunity.
And it's really interesting because you look at what next year is lined up, right? We all, I think, agree that valuations are relatively high on the equity side. You have about a 11% earnings growth built into the market now, I think, is about where you're at. So that's a really, we got for this to keep going, that has to be a really, really good, some good things there. And so, AI, I think, could come in and really help us potentially with productivity gains, potentially maintain that earnings growth that we're all sort of striving for. Again, as you said, it comes back to the numbers we'll see next year.
And your comment about the messaging, don't forget the market's already priced in, I think, 125 basis points of rates cuts coming already, right? So the messaging will be interesting in terms of how the Fed calms out a bit in terms of, maybe higher for a little longer, and then we'll see. Because right now, there's definitely a bull element that's in there.
I mean, it makes you wonder, with the move that we see in small caps, if there's this expectation that rates are going to come down, and we know that small cap companies are even more susceptible to cost of capital. I mean, they're smaller companies; they don't have, their balance sheets aren't quite as big as a Microsoft and Apple and Amazon. You wonder if some of the bullish sentiment we've seen is pricing that in. That cost of capital is going to get cheaper, as an example.
Right, you're absolutely right. So that's why we really focus on companies have very strong balance sheet, structurally high margin. They can control their own destiny, that they can fund their own growth. So that's very important. So they can still do well when, then they can actually take advantage of, the competitors, weaker competitors, right? Consolidation. I think that would be a big theme. I think the stronger company will become even stronger to that. And back to the, what David said about valuation, it's just that small cap actually is still very cheap. Small cap growth, now the S&P 600 small cap growth index is trading at 18 times versus discount to the S&P 500. I know that gap has narrowed a little bit since I was here last time, right? But it's still a big gap because historically, on average in the last 20 years, small cap has been trading at on average like 14% premium to large cap. So that no matter what, the reversion to mean, it's already happening in November, but there's a lot more catch up to do. But of course, at the end of the day, it's going to be stronger fundamentals. So we really focus on company that, at Alger we call positive dynamic change that can accelerate growth with margin expansion in 2024. I think those companies are going to be winners.
All right, Amy, we will leave it at the small caps. I appreciate everyone joining us on Trade Talks today. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.